Hey, what's up, guys? This is Greg from Genesis Volatility. So I'm going to go ahead and describe a call spread to you guys today. Just a quick reminder, none of this is trading advice. It's just for educational purposes only. But let's go ahead and jump into it. So the first thing I like to do is look at the underlying spot market. So today we'll be looking at Ethereum. I think there's a lot of sort of interesting things happening around Ethereum. So, for example, earlier this week we had Goldman Sachs saying that they think that Ethereum will overtake Bitcoin's market cap. We had Carl Icahn yesterday saying that he's looking to get exposure to the crypto market and that he thinks Ethereum is more interesting than Bitcoin. And I really think that Ethereum, with some of the developments coming along down the road, such as proof of stake, which sort of is a sort of greener blockchain technology than Bitcoin's proof of work. You also have yielding in the proof of stake. You also have EIP 1559 coming online, which is going to burn some of the ETH from every transaction, which can create like a deflationary force to the underlying Ethereum market. So you kind of have a lot of positive developments, fundamentally speaking. But then let's go ahead and see how we can structure sort of that bullish bias in the options market. So today is May 27th. Last week we saw a huge sell-off in the crypto market. We saw basically ETH drop from 4,000, 4,100 all the way down below $2,000. So we had a huge sell-off that happened really quickly. This basically sent volatility soaring. So if I look at the volatility cone, I can look at the volatility cone from the past 1 year, and I could see for pretty much every measurement window that realized volatility is at the maximum it's been in the past 12 months. So 14-day vols at 285, 30-day vols at 209, 90-day vols 144. So really high realized vol numbers. Now, what this tells me is that options are going to be expensive. If I go ahead and sort of look at the underlying options market, you can do this directly from bit.com, data info, Genesis vol charts, and we can sort of see where Ethereum options are trading. So there's going to be a couple things to notice. The first thing to notice is that all the skews are still really negative. So people are still kind of reeling from this past sell-off, and they're still willing to pay a little bit more for put protection than they are for call upside. And then something else that you'll notice is that the volatility term structure is still really high. So we can see that the volatility levels, I mean, we're looking at implied vols between 165 and 135. So those are still really high vol numbers. Even though it's lower than realized vol, implied vol is sort of discounting future realized vol to be lower in the future. But we're still in a backwardated volatility environment, which is congruent with a high volatility kind of environment that we're in right now. Something else I want to look at is basically the open interest. So I can see the open interest right now is mostly concentrated in this end of month, May 28th expiration, and this quarterly June 25th expiration. So June 25th is sort of where I want to play. It's got the most liquidity. I can go ahead and even narrow this down further. So if I want to look at June 25th only, I can use this slider and basically isolate for that contract expiration. And now I can see which strikes are the most popular. So we can see that this 35.20, which is an interesting place to buy a call, and maybe this 38.40, which is a little less liquid, but it really gives you a good idea like which strikes to pick and where the liquidity can be found. So if I tab back over here and I look at the options ladder for Ethereum, I can see here basically that something like buying this 35.20 call, which expires in 28 days, and selling this 38.40 call. So I'm basically paying 190 minus 90. So I'm paying $100 to make $320 or 220 of profit. So if everything goes according to plan and ETH recovers nicely, I turn $1 into $3.20. So there's a nice a little over 3-to-1 risk reward ratio, and the most I can lose in this call spread is the debit that I paid, the $100 per unit. So the idea here is that even though realized vol is really high, and I think we can come back with some good realized volatility, considering that 3,500 is much farther than the 2,700 that we are at today. So I think there's enough volatility to bring us back to these levels and through these levels, all the way past 3840. I also don't want to overpay because this is still a high volatility environment. So I'm paying 138 vol to buy this 3520 call. So I kind of want to finance that by selling this 3840. And something that's nice there is that by financing that, I can sort of buy more contracts. So I can buy almost two spreads for instead of one option. So if I kind of think that $4,000 is the level we're going to go back to anyways, and then maybe $4,000, which is the previous high, might give us a little resistance. I'd rather have two call spreads instead of one outright call. That's another kind of way to think about it. So I'm going to hand it over to Mickey, but basically I think that this kind of call spread is perfect for execution on a platform like Paradigm, because you want to get midpoint execution as opposed to lifting the ask and selling the bid, which is sort of going to be the worst execution. If you can sort of get a fair price near in between the market, you can really put a lot of these things on, and you don't have to hold them all the way to expiration. You can get a little bit of a rally, maybe call it to 3,100, 3,200, and then you can start taking some of these off and trade them that way as well. So this is a call spread idea, and I'll hand it over.
Thanks, Greg. You're absolutely right. The most efficient way to execute a position like this is to trade it as a spread in a single execution manner, such as that provided through Paradigm. And I'm happy to show you that process now. Again, welcome everyone to the main Paradigm trade screen. I'm going to jump right into building and executing Greg's call spread. But if you have any questions, please feel free to reach out to me or the Paradigm sales team. We are more than happy to walk you through understanding the trade workflows in more detail. And I'll be sure to leave our contact information at the end of this video. So to start the process of building the ETH June 25th, 3520, 3840 call spread, I'll first click the RFQ or request for quote button here. Next, we'll get a nice pop-up window to fill in the structure details. I'll set it to bit.com, ETH options, and simply choose call spread from the available predefined structures. The builder auto-populates the call spread's two legs, and all we have to fill in are the structure details. From the analysis, I will set the expiry to June 25th and select the 3520 and the 3840 strikes for each leg. For this example, I'm going to say we want to put on the call spread 500 times. Then I'll just input that quantity here. I want to request pricing from all the liquidity providers, so I make that selection and click send. Next, I will receive automated market maker responses on the net premium of this spread, which again resonates with Greg's commentary on getting fair execution and not having to pay bid-ask on each leg. As more and better prices come in, the best bid and offer will update accordingly, and those prices will flash here. Once I see a price that looks attractive, all I have to do is simply click buy, as Greg mentioned in his commentary, and as a single package, I executed both legs of the structure simultaneously. Immediately, I also see the notifications in my bit.com side, and it automatically hits my bit.com account. To see more granularity, I can go into my bit.com trade history, or here on Paradigm, I'll look at the details of the trade confirmation. We can see I bought the 3520s versus selling the 3840 calls. Thank you everyone for watching. For more information on Genesis volatility, head to gvol.io, and to learn about Paradigm, please visit paradigm.co. We look forward to connecting with you and welcoming you to both of our products. Thank you again, and happy trading.